Here's what the headlines told you on June 5, 2026. Broadcom disappoints, sends chipmakers into freefall. Nasdaq has its worst day since April 2025. That's the story you were sold. Now here's what actually happened. Broadcom reported $22 billion in revenue for the quarter. Beat expectations. EPS of $2.44 beat expectations. And they guided their AI semiconductor revenue to $16 billion next quarter. The highest AI revenue forecast in the company's history. Beat the analyst consensus on total guidance. On every single metric that should matter, Broadcom delivered. And the stock still lost approximately 15% in 2 days. So if Broadcom didn't fail, why did the Nasdaq lose 4.18%? Why did semiconductor stocks have their worst day since March of 2020? Why did over $1 trillion in chip market value disappear in a single afternoon? I'm going to tell you exactly why, and once you understand the mechanism, you're going to start seeing it everywhere. If you're a long-term investor, someone building toward retirement, someone holding index funds and dividend ETFs, June 5th probably looked like just another scary day. A bad headline. Noise. It wasn't noise. What happened on June 5th is the same thing that keeps happening in this market, over and over, and most investors still don't have a clear mental model for why. Here's the one-sentence version. AI stocks are not valued on what they earn today. They're valued on what they're expected to earn 10, 15 years from now. And the present value of those future earnings depends entirely on interest rates. When rates go up, or when the market thinks rates are going up, the math changes. Fast. Kevin Warsh became the Federal Reserve Chair on May 22nd of this year. He was confirmed by the Senate 54-45 on May 13th. And the market that's pricing in a 68% chance of a rate hike by December is pricing in a Fed that is in no hurry to give the market what it wants. This matters for every dollar you have invested in growth technology. Let me show you the numbers. June 3rd, 2026. After the market closes, Broadcom releases its fiscal Q2 results. Revenue, $22.187 billion. The street expected $22.13 billion. Beat, non-GAAP earnings per share, $2.44. Consensus was $2.40. Beat, AI semiconductor revenue for the quarter, $10.8 billion. And then they guide Q3, total revenue of $29.4 billion. Above the analyst consensus of $28.53 billion. And on the AI segment specifically, they say on the earnings call, we expect Q3 AI semiconductor revenue of $16 billion. The highest quarterly AI forecast they have ever given. This should have been a great night for Broadcom shareholders. It wasn't. By June 5th, the stock is down approximately 15%. And here's where it gets interesting, because the real detonator wasn't Broadcom at all. At 8:30 a.m. Eastern on June 5th, the Bureau of Labor Statistics drops the May jobs report. 172,000 non-farm payrolls added. The Dow Jones consensus forecast was 80,000. That's more than double what economists expected. Unemployment held steady at 4.3%. Average hourly earnings up 3.4% year over year. The labor market is not cooling. It is not softening. It is strong. And a strong labor market means the Fed has no reason to cut rates. By the time the market opened, the probability of a rate hike in December had jumped from 52% to 68.4%. According to CME futures, the odds of any rate cut in 2026 were slashed to near zero. The Nasdaq closed down 4.18%, its worst day since April 2025. The S&P 500 fell 2.64%. The Dow fell 1.35%. Semiconductor stocks had their worst single day since March of 2020. Nvidia dropped 6%. Micron dropped over 7%. AMD fell 3%. The chip sector lost over $1 trillion in market value in one session. And through all of it, while all of that was happening, SCHD finished the year to that point, up 18.75%. Let me explain the mechanism, because this is the part most financial media glosses over. When you buy a growth stock like Nvidia or Broadcom, you're not really buying the business as it exists today. You're buying a claim on its future cash flows, the revenue and profits it will generate 5, 10, 15 years from now. To figure out what those future profits are worth today, investors use a model called discounted cash flow, and the discount rate in that model, the number that determines how much future profits are worth right now, is tied directly to interest rates. When rates are near zero, future cash flows are barely discounted. $1 of profit in 2040 is almost worth $1 today. Valuations can go to the moon and still be mathematically defensible. When rates are at 3.75% and when the market is pricing in a chance they go higher, that future dollar shrinks significantly. And the math changes on every AI company simultaneously. Right now, the Nasdaq 100 is trading at roughly 31 to 35 times earnings. The historical median is around 24.5 times. That premium, that gap above the long-run average, exists because the market spent years assuming rates would come back down, that the Fed would blink. Kevin Warsh is signaling the Fed may not blink. Here's what Kevin Warsh actually said. Not what analysts said about him, but his own words, published in the New York Times in February of this year. He called the AI revolution the most productivity-enhancing wave of our lifetime, past, present, and future. He called it structurally disinflationary, and he argued central bankers should take a chance on anticipating the productivity boost that AI will deliver. Now, here's the tension. If Warsh genuinely believes AI is disinflationary, that it will naturally bring prices down over time, then he has less urgency to cut rates to stimulate the economy, not more. He can wait, he can hold, he can let the data come in. And a jobs report like May's, 172,000 jobs when the street expected 80,000, gives him exactly the cover to do that. The current Fed funds rate sits at 3.50 to 3.75%. Rate cuts in 2026 are now essentially off the table, and the probability of a hike by December, before this jobs report, before June 5th, was already at 52%, meaning the market was already coin-flipping on whether we'd see a hike this year. That is the structural condition AI stocks are operating in. Every time a strong macro number comes in, the same repricing happens. Broadcom was the trigger on June 5th. The jobs report was the accelerant. Kevin Warsh's Fed is the reason the fire keeps burning. I want to be honest with you about the counter-argument because it's a real one. The bull case for AI stocks says that revenue growth is fast enough to make rate sensitivity irrelevant, that companies like Nvidia and Broadcom are growing so quickly and generating so much real cash that even a higher discount rate doesn't change the fundamental investment case, that June 5th was an overreaction, a one-day event, and that the companies themselves are fine. On the current quarter numbers, that argument has support. Broadcom's Q2 was genuinely strong. AI infrastructure spending isn't slowing down. The $16 billion AI revenue guidance is a real number, not a projection built on hope. These are not companies in trouble. But here's what the bull case misses. It's not about whether these companies are good businesses. They might be exceptional businesses. It's about what price you're paying for them. At 31 to 35 times earnings, with rates at 3.75% and the probability of a hike rising, you are paying for perfection. And in a high-rate environment, perfection has a higher cost because every dollar of future earnings is worth less today than it was when rates were near zero. While the Nasdaq was having its worst day in over a year, SCHD The Schwab U.S. Dividend Equity ETF was up 18.75% for the year to that point. That's not a coincidence. That's a different valuation model entirely. Dividend stocks are valued primarily on what they pay today and what they're expected to pay in the near term. They're less sensitive to the discount rate because their cash flows aren't as far out on the timeline. A company paying a solid dividend yield today, growing that dividend consistently year over year, looks more and more attractive when the Fed holds at 3.75%. Compared to a company whose entire valuation rests on cash flows it might generate in 2035. SCHD, held because its holdings, financials, energy, industrials, healthcare, consumer staples, are built for exactly this kind of environment. Not because someone predicted June 5th, because the structure of those businesses doesn't depend on cheap money to justify their price. Other dividend ETFs told the same story. DGRO was up 8.79% for the year. VIG up 6.56%. The dividend category, broadly, held while AI chips were having their worst week in years. If you're a long-term investor, I'm not telling you to sell your index funds. I'm not making a market timing call. What I'm saying is this: your exposure to interest rate risk in your portfolio is probably higher than you think, because growth and AI make up an enormous share of the major indexes. Adding dividend exposure, SCHD, DGRO, or similar, doesn't mean abandoning growth. It means building a portfolio that can hold its ground when Kevin Warsh decides the data doesn't justify a cut. That's not a prediction about what the Fed will do next. It's a structural decision about what you own and why. If this video helped you think more clearly about what actually happened on June 5th and what it means for how you're positioned going forward, hit the like button. It tells me this kind of analysis is what you want more of. Next week, I'm going to look at something a lot of people have been asking about: buying index funds at all-time highs. Is it a catastrophic mistake, or is the fear bigger than the historical reality? The data is more interesting than most people expect. Subscribe so you don't miss it. I'm the mentor. Smart money, simple steps.